In a week that was always going to be dominated by inflation, we now also have the US CPI released on Friday. But alongside that, on Wednesday, we see the UK inflation report. Of course, the Bank of England have been restricted in terms of how loose their monetary policy can be, owing to the elevated nature of UK inflation. And this, of course, is an opportunity to show that perhaps the UK is on a different course. So what are we going to see? What's the impact for the likes of the pound, the likes of the FTSE 100? Let's get into it and more on today's video. As ever, we're going to look at the outlook according to Trading Economics economic calendar. And unfortunately, it doesn't look great when you look at the top line numbers. So you can see here, the forecast is a return to 4% for headline inflation, the first time we would have seen that number since January 2024. Then core inflation also expected to rise. So higher across both headline and core. I mean, that could essentially be the headline, and that would be reason for people to grow increasingly fearful. But look at the monthly figures, right? 0.2 expected across both headline and core. And that, to me, points towards inflation potentially being under control for the month, because roughly that's where we need to be to get back towards target, or roughly towards target. So what's the truth behind it? Are we actually heading in the right direction, or would the year-on-year figures be right in proving that the UK is completely off track and that the Bank of England is not going to be able to do much for a long time? Well, first and foremost, the IMF have had their say recently, and they have said that the UK in 2026 will have the highest rate of inflation of all G7 nations, following the highest level of inflation in 2025. In terms of growth, actually, it was better than expected on that front. But certainly inflation remains a sticking point and a thorn in the side of the government, a thorn in the side of the Bank of England, and certainly something they will want to address. There's talk of them removing at the budget the VAT on energy payments. Whether that's going to reverse the other measures that they take remains to be seen. But very clearly, they're taking inflation very seriously at the moment. Notably, if you look at many of the sort of major countries in the Western world, you'll be able to see that inflation for the UK stands well above the rest. And you can see here that the second highest comes in at 3%, the UK near enough at 4%. So in a very difficult situation, and that's why we've seen inflation leading to interest rates remaining elevated. Now, wage growth has been one factor. It has been relatively strong, but in terms of real wage growth, so when you're factoring in inflation, that has been dropping off and normalizing. So that's something that could put a bit of downward pressure on inflation. And like I said, when you look at where interest rates are, it's essentially the UK and the US that are at the top of the pile here. Many central banks have already been cutting for quite a while now. You can see that the top is the Federal Reserve, but there's an expectation, of course, that the Fed are going to cut at the remaining two meetings of this year. And also there is over 50% chance priced in, according to the CME, that the Fed cut in January. So that means it won't be long before the Bank of England is at the top of the pile here. And then you've got the RBA a little bit below that. But certainly some of these other central banks have really run away with it. RBNZ, the likes of the Bank of Canada, the ECB, and then all the way at the bottom, the Swiss National Bank. So here's where we stand in terms of inflation. Now, ultimately, the part that I think is most important really alludes to what we were talking about when we were looking at the economic calendar at the beginning, and that's the expectation that we're going to see 0.2 across both headline and core for the month. And ultimately, if you look at the year-on-year figure, that has 12 months worth of data for you to consider. That means it can be heavily skewed by what's happened a long time ago and doesn't necessarily have that much relevance anymore. The flip side of it is the monthly is literally the latest reading that tells you exactly what's happening at the moment. Of course, from 1 month to the next, you can get fluctuations and variations, and that's why I like to look at across a handful of months. So firstly, by just looking and eyeballing the month on months, you can see exactly where the problematic months are and where things might change, and then you're utilizing annualized figures. So what we can see here is the last time around it was at 0.3 across headline and core. It's a little bit high, but that's still not necessarily problematic. If you look back at, say, October of last year, if you're looking at February, March, and of course, April, which is the big standout column here, that's where we saw really elevated inflation. And as time goes on, those figures will be stripped out. And as they're replaced with hopefully lower numbers, so you would see those year-on-year figures drop. However, this time around, markets are expecting to see the year-on-year figures rise, despite the fact that they're expecting a pretty reasonable 0.2 on the monthlies. And the reason for that is, if you look at where we're filling it in on the right, it's September. So you look back at September of last year, and you can see that inflation was pretty much non-existent. But October, we saw pretty strong inflation. So what that means is, pretty much unless we see 0% on the CPI and the core CPI, we're going to see year-on-year inflation rise. But that doesn't mean it's problematic. And certainly fast forward a month from now, it's very likely we'll see inflation drop. In particular, if we saw 0.2, we could see a pretty substantial decline in terms of both headline, in particular headline, but also core inflation for October. This time around, we've got to take the hit and realize that inflation is just going to look awful. Same kind of thing in November. It looks like it won't look great. January's again another month that's going to be a difficult comparative. But then at the beginning of next year, you can see February, March, April, some really significant ones that drop out. We can see disinflation in a very meaningful manner. Of course, the Bank of England are well aware of this. So they want to know that inflation's tracking on a decent pathway. And you can see the past 4 months, that has been the case. If you add the 0.2s that markets are expecting, that means 5 months of inflation being under control. Whereas the April inflation sort of burst, much of it came down to the policies under which the Labour Party came in and shook things up. So it was a change in terms of the price cap for energy in the UK. It was a shift in terms of national insurance payments, a shift in terms of minimum wage, those kind of things. And we saw an inflationary boost, a one-off inflationary boost. Now, you could look at what's happening in terms of the Federal Reserve, and they've said, well, when it comes to tariffs, as long as we know what we're dealing with, if it's a one-off boost in prices, we can look through it. So the question mark here is, will the Bank of England, if they continue to get information to say that inflation on the near term is under control, will they be able to look through that April figure, or do we have to wait until that April figure stripped out to see them really ramp up their easing? In terms of the 3-month annualized, you can see that the core figure, according to the past 3 months, is tracking at a pace of 3%. That is below where we are at the moment, but it's also above target. And then headline 2.55. Again, same comment applies. In terms of the outlook for the Bank of England, we can see here there's an expectation of no change at this November meeting. Then December, a similar kind of story. The next cut expected for February. And even then, you're looking at 67% chance. So it's not like we're all guaranteed a rate cut in February. That being said, remember, April's when we're going to see all the April figures. When they're stripped out, that's when we really see disinflation likely coming into play. There's, of course, question marks and concerns around the upcoming budget. If they implement measures that cause another spike in inflation, we could be back to square one, quite frankly. But certainly if we do come in with, say, a 0.2s, or low inflation monthly metrics this time around, we could see some growth in terms of expectations over nearer term rate cuts from the Bank of England as they see increased confidence, or they see increased data to prove that inflation beyond that one-off spike in April has largely been tamed. What does this mean in terms of trading, though? So you can see here that I have overlaid euro sterling with the ratio between the Eurozone or Euro area 2-year yield and the UK 2-year yield. The reason that I've chosen the 2-year yield is that the short end of the curve, or the lower length of time attributed to the bond or the treasury, typically is more responsive or reflective of where markets think interest rates are going to be over the near term. So it's more reactive to the policies of, say, the Federal Reserve or the ECB or the Bank of England or whoever the relevant central bank is for that treasury bill. And the flip side is, say, the 30 years, which is really long term. And that's going to be more really reactive to sort of structural confidence or a lack of confidence around the direction of travel for an economy over the long term. But we're dealing with the short term. So this gives us a good idea of market perception around interest rates for the likes of the ECB versus the pound. And this is something that I've been talking about for a while, quite frankly, because I have this view that once you see the ECB essentially end their easing, despite the fact that many will say, okay, well, they've got really low interest rates, that's when soon enough we're going to see the Bank of England having to start ramping up their easing, hopefully data dependent, and in which case it would spark the potential for upside for euro sterling. But you don't necessarily know exactly how the data is going to come out and when these things are going to happen. That's why these data releases are so important. Then the flip side of it is this. I mean, I say the flip side, but it's a very similar story, right? Look at these two charts. This one is the FTSE divided by the DAX. And what it means is there's an expectation that when you see the likes of the Bank of England cutting interest rates, it's good for the UK economy. The flip side is if we see the ECB cutting rates and the Bank of England continues to hold off, people favour the DAX. So that, of course, is a relative basis. So we could see both of them decline or both of them gain ground. And it's just relative between the two. And a caveat here also is if you were to see heightened expectations of rate cuts from, say, the Bank of England, but it comes via weak economic data, like a collapse in terms of the jobs data or a sharp spike in terms of unemployment rate, that's not necessarily great news for the stock market in the same way as a weak inflation gauge would. So certainly inflation is going to be the more beneficial one when it comes to stocks. If we see weak inflation, then that's good news for the UK stocks. So let's look at the charts and sort of round this up to see exactly how things are looking. First and foremost, we had euro sterling. So let's just jump onto that. And so we can see, let's go on the wider time frame. So like I said, we've been talking throughout all of this, and I keep highlighting the fact that the pound is likely to weaken once we see a move towards that moment where the ECB have essentially done it all and the Bank of England have got it all ahead of them. And we're kind of grinding higher at the moment. Now, most notably, recently, we've pulled back into the 76.4 Fibonacci level alongside this ascending trend line. That support level held. We rallied. We didn't take out your first swing high, which is 87296. We've pulled back once again. We're coming back towards this trend line again. So at the moment, it's almost like we're sort of ranging, right, between this 867 up to 872. And so given the fact that we're at the bottom here, we've got this ascending trend line. We've also, at a stretch, got this 76.4 fib. I think the closer we get towards this zone, the more it favors the bulls, even if it's just a short-term move here. But certainly if we see a breakout through 8729, then it brings greater confidence of another strong move higher for this pair. But again, that's likely to be data dependent, and we'll see how the data comes out. Then let's look at the FTSE 100, and we can see here in terms of the daily time frame, very clearly, we've got a very nice uptrend in play here. Over the course of the past week, we have seen stocks pulling back, but for me, that looks like a retracement. The sort of near-term swing lows you're looking at are these two. Let's just take that away from being percentage. And there you go. So 9179, 9180, and then below that 9102. In terms of the Fibonacci, we can see absolutely perfectly. We've tagged the 76.4 fib, and now we're starting to regain ground. So essentially, if we start to break these support levels, then it tells a different story. But until that happens, for me, the FTSE 100 remains in a positive footing. And you can say that if this CPI number comes out relatively weak, even just as expected at 0.2s, for me, that's good news for the likes of the UK economy, because it means that inflation is under control for the 5th consecutive month, despite what that year-on-year figure is going to tell you. And remember, that year-on-year figure will tell you something different in a month's time. I hope that's been useful. Make sure to like, subscribe, and follow for more. My name is Josh Mahony, Chief Market Analyst at Scope Markets. Have a great day.